3 dates. Etch them into your mind. December 27th, 2025, January 26th, 2026, March 26th, 2026. These aren't predictions. These aren't decorative support and resistance lines scribbled on a chart. These are the 3 pressure windows where the mathematical forces inside the silver market reach critical mass, where decades of suppression collide with physical truth, where paper promises finally confront delivery obligations they cannot satisfy, and where the widening gulf between what COMEX claims exists and what is actually sitting in those vaults becomes undeniable. One of these 3 dates could ignite the break. The moment silver stops trading like a commodity and begins trading like a crisis asset. When the price doesn't rise, it gaps. When premiums don't increase, they detonate. When the system can't adjust, it fractures. Over the next 15 minutes, I'm going to show you precisely why these dates matter. I'll guide you through what unfolds at each window. The backwardation on India's MCX screaming physical scarcity. The evaporation of COMEX futures as shorts frantically escape December delivery. The LBMA shipment delays into India confirming that the physical supply chain is visibly breaking. And the 5-year global supply deficit that has drained every buffer the system once relied on. By the end, you'll understand why December 27th is the first shock window, why January 26th could ignite a mini squeeze, and why March 26th represents the unavoidable endgame, the moment when the shorts have literally nowhere left to run. This isn't hype, this is pressure, mathematically measurable, visually observable, and on the verge of releasing. Let's begin with the catalyst that sets all 3 dates in motion, the COMEX futures rollover. The December breakdown. In December 2025, something unprecedented occurred. December silver futures, normally a steady delivery month, collapsed. Why is December a nightmare for shorts? 2 reasons: year-end balance sheets and Indian demand. December marks fiscal year-end for institutions. Banks close their books, regulators review exposures, shareholders scrutinize holdings. No trader wants a massive physical delivery obligation sitting on their December 31st balance sheet. It's a liability. It requires capital reserves, it provokes uncomfortable questions, so banks push their traders to roll, close, and avoid delivery at all costs. But on the other side of the market, India is entering peak demand season. India is the world's largest silver importer, over 200 million ounces annually. And December through January is the wedding and festival window. Diwali, Dhanteras, weddings, gifting season, silver jewelry, bars, and coins fly off shelves, physical demand surges. But this year, 2025, demand isn't merely strong, it is panic level. India's MCX is flashing sirens. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the multi-commodity exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. On the Multi-Commodity Exchange of India, MCX, silver is showing extreme backwardation. Backwardation means spot trades above futures, meaning immediate delivery costs more than delivery months away. This flips normal market structure upside down. Futures should usually trade higher because storage and financing add cost. But today, Indian spot is 95,000 rupees per kilogram, outpacing future months. Backwardation is the market shouting one message: we are running out of metal. And it's not just India. LBMA, a supply chain under stress. The LBMA in London, supposedly the deepest silver vault system on Earth, is experiencing the same strain. Importers in India report 30-day delays on shipments from London. Orders placed in November are now arriving in late December or even January. This has never happened in modern bullion history. LBMA vaults held over 1 billion ounces in 2020. By 2025, inventories have collapsed below 750 million, a 25% drawdown and accelerating. In 2025 alone, more than 100 million ounces vanished from the vaults. Some absorbed by industrial demand, some drained into COMEX to prevent delivery failures, some shipped to India to quell shortages. But what's not flowing in? Replacement supply. Mine production is flat. Recycling is stagnant. Vaults are bleeding metal with no replenishment. That's not tightness. That's structural breakdown. December 27th, the first shock window. December 27th is the final trading day before year-end, the expiration of December futures, the deadline for delivery notices, and the opening of the year-end squeeze corridor. Here's the setup. Indian demand is surging. MCX backwardation is extreme. Physical premiums in India are $3 to $5 per ounce above COMEX. Importers are desperate to secure silver before the January wedding season. At the same time, COMEX shorts have already rolled the majority of their December positions into March. But a dangerous residue remains. 30,000 contracts, equivalent to 150 million ounces. If even 5% of those contracts stand for delivery, that's 7.5 million ounces. COMEX claims 152 million ounces in registered inventory, but the real deliverable float, the metal that can actually move, is closer to 15 to 20 million ounces. 7.5 million ounce request is barely manageable under perfect conditions. But if it collides with record Indian physical demand, delivery stress becomes compounded and amplified. And this, right here, is the catalyst. December 27th, a major Indian importer or industrial giant steps forward and declares they're taking delivery on 2,000 COMEX contracts, 10 million ounces. It's legal, it's their right. They own the contracts. But COMEX does not have 10 million ounces ready for immediate withdrawal. They must scramble, pulling metal from registered inventories, transferring bars from distant vaults, sourcing whatever they can find. This takes time, days, maybe even weeks. And during that delay, the market smells blood. Longs recognize weakness, they see stress, they demand delivery as well. Suddenly, 5% becomes 8%, 8% becomes 12%. Requests cascade, and COMEX faces a brutal binary decision: deliver and drain the vaults to dangerously fragile levels, or force cash settlement, a public admission that they cannot deliver the metal. Either choice detonates the market. Silver gaps from $33 to $40 overnight. Physical premiums in India rocket to $8 to $10 over spot. MCX backwardation widens to 5%. The first shockwave hits the global system. Will this definitely happen on December 27th? Not necessarily. It's a window of probability, not a guaranteed trigger, but the ingredients are real and documented. Indian demand is extraordinary. MCX backwardation is screaming shortage. COMEX registered inventory is constrained. If the spark doesn't strike on December 27th, the pressure simply rolls forward into the next window. January 26, 2026. The second critical date, January 26th, sits 1 month after year-end, when fiscal reporting finishes, when balance sheet pressure eases, and when institutions reshuffle their positions without scrutiny. It also happens to be the peak of India's wedding season, the single most silver-intensive month of the year. If December was tight, January will be suffocating. Here's why. LBMA delays from December still haven't cleared. Shipments ordered in November are only just arriving. Orders placed in December won't land until late January. Indian vaults are thinning out. Jewelers need metal, mints need metal, industrial users need metal, and they're all chasing the same shrinking pool of supply. Meanwhile, on COMEX, February futures become the active contract. If December's rollover chaos repeats, shorts will once again stampede out of February and into March, avoiding delivery at all costs. But every roll comes with a price. March futures trade at a premium. The spread widens. Rolling bleeds capital. Eventually, some shorts simply cannot afford to roll anymore. They're forced to buy back their positions outright, and that involuntary buying pressure sends prices spiking. Thus, January 26th becomes a mini squeeze window, not the final collapse, but a violent, unmistakable shock. Silver may gap from $40 to $55 or even $60. Indian physical premiums explode to $12 to $15 over spot. COMEX registered inventory slips below 140 million ounces. The vaults are visibly draining, and the market begins to price in March as the unavoidable breaking point. But understand this clearly. December and January are symptoms. The disease is March. March 26, 2026, the final convergence point. March 26th is not a window, it is the event. March is when the accumulated pressure, delays, deficits, rollovers, and shorts all collide in one irreversible moment. March open interest sits at 95,000 contracts and rising. By expiration, it could easily hit 100,000 to 110,000 contracts, 500 to 550 million ounces of paper claims. COMEX registered silver will likely be below 140 million ounces by then, but the deliverable float, metal that can actually leave the vault, will be more like 12 to 15 million ounces. But lower rates don't magically help. Renters, minimum wage earners, people with no savings and no collateral. They can't borrow cheaply to buy assets. They just watch their rent, food, and basic costs stay elevated while their wages barely move. The result? The gap widens. Wealth inequality explodes, and the system pats itself on the back and calls it recovery. This is the endgame of modern monetary policy. Inflate asset prices, suppress wage growth, call the outcome economic growth. And when the cost of living becomes unbearable, when social unrest rises, when political instability erupts, they will act shocked. They'll blame unexpected external shocks, foreign conflicts, pandemics, anything but the truth. They will never admit the system is designed like this. So here's the reality. Inflation at 3% does not mean prices are stable. It means prices are rising 3% on top of the 20 to 30% increase you already absorbed. The cost of living trap means that even if inflation went to 0% tomorrow, you'd still be stuck paying permanently elevated prices with stagnant wages. The 1970s parallel tells you something even more dangerous. This stable 3% phase is often the calm before the second wave. One new shock, tariffs, war, energy crisis, debt event, and inflation doesn't creep higher. It erupts like it did from 3% to 14% in the late 1970s. Meanwhile, CPI itself is a mathematical construct, engineered to understate real inflation, to justify lower interest rates, to protect government finances, to limit cost of living adjustments on entitlements, to keep asset prices supported, all at your expense. And nobody in power truly wants to fix it because asset owners want low rates and rising asset prices. Governments want low official inflation numbers to reduce payouts. Corporations want cheap labor and high prices. Everyone with influence benefits. You, holding dollars, paying rent, buying groceries, you are the one who loses. So what do you do with this information? 1. Realize you're not crazy. That disconnect you feel between the headlines and your bank account? It's real. The gap between official inflation and real-world prices is documented and intentional. 2. Don't treat falling CPI as salvation. A lower CPI doesn't mean prices are dropping. It means they're climbing slower from an already inflated base. That does not heal your finances. 3. Position for the next wave. If we're sitting at 3% today, history says inflation could spike to 10% or more within a couple of years. That's the 1970s template. You protect yourself with hard assets, real estate. If you can lock in a fixed rate mortgage, gold, silver, energy, food, key commodities, skills, and income growth. If wages are the weak point, attack that. Improve your skills, education, earning power, and side businesses. You cannot control CPI, but you can control your income trajectory. Debt structure. Fixed rate debt can be an asset in an inflation spike. Your payment stays constant as incomes and asset values rise. Variable rate debt can destroy you as rates jump. Avoid it or minimize it. 4. Vote, advocate, and pay attention. This system is not natural. It is the result of policy decisions over decades. It can be changed, but only if enough people understand what's happening and demand reform instead of accepting carefully packaged statistics. Here's the final message. America's cost of living trap is not an accident. It is the logical outcome of 50 years of policy designed to inflate assets, suppress wages, and mask the damage behind a 3% inflation headline. Official inflation at 3% hides the fact that many essential prices are 30% to 200% higher than 5 years ago, while wages might be up 10 to 15% at best. That difference is the gap. That gap is the trap, and it's widening. The 1970s already showed us this movie. First, the stable, 3%. Then, the explosion to 14%. We are in the stable phase now. The explosive phase is what comes next. And when it hits, the people sitting in cash, the people without assets, the families living paycheck to paycheck, they will be the ones crushed. The system will blame external events, but the truth is simple. They built this trap, and you're living inside it. If this peeled back the curtain on what's really happening behind the low inflation headlines, subscribe, because in the next phase, when the second inflation wave hits, when the asset bubble pops, when the cost of living crisis mutates into a full-blown political crisis, you're going to want to understand every step. Thank you guys, see you next video. Now here's the math. If 5% of longs demand delivery, 25 to 27 million ounces required, COMEX shortfall, 10 to 12 million ounces. If 10% demand delivery, 50 to 55 million ounces required. COMEX shortfall, 35 to 40 million ounces. The system does not bend, it breaks. Why can't they avoid March? Because every short who escaped December rolled into March. Every February short rolls into March. March becomes the final stand. You cannot roll March into May without signaling to the entire world, we cannot deliver the metal. So what happens? COMEX has only one option. They force cash settlement. They invoke force majeure. They announce that physical delivery is impractical. All remaining contracts are settled in dollars at the prevailing price. Let's assume silver is $60 by mid-March. They settle the 40 million ounce shortfall at that price, $2.4 billion in cash payouts. COMEX can survive the payout financially, but the credibility damage is fatal. Industrial users will know COMEX contracts do not guarantee metal. Investors will know paper silver is fiction, and the entire market will decouple. Physical premiums explode to $30, $40, $50 plus. COMEX trades at $60. Physical silver in India trades at $110. London trades at $100. Private off-exchange deals trade at $120 plus. The paper price dies. The real price becomes whatever people are willing to pay for actual metal. true price discovery returns, driven by miners, refiners, industrial buyers, and sovereign purchasers. And in that environment, silver could easily discover a price of $200, $300, $400, or higher. Because we have never seen the paper system collapse on a metal this strategically vital. The United States Strategic Silver Reserve was completely exhausted in 2002. Since then, America has had no emergency stockpile, and the deficit is now accelerating at a historic pace. The reason is simple yet staggering. Industrial demand is exploding. Solar panels alone devour nearly 200 million ounces every year, a dramatic leap from just 85 million ounces in 2020. Electric vehicles consume double the silver of traditional gas-powered cars, and EV production is surging nearly 20% annually. Add to that the worldwide rollout of 5G networks, the boom of AI mega data centers requiring enormous cooling systems, plus the rising demand for medical devices, semiconductors, and every form of modern electronics. All of it consumes silver, and nothing on Earth replaces silver's conductivity at the same efficiency. Meanwhile, global mine supply is stagnant, locked at 830 million ounces per year, the same level for nearly a decade. Why? Because 70% of all silver is produced as a secondary byproduct of copper, zinc, and lead mining. You cannot simply mine more silver. Base metal prices have been erratic, investment in new mines is low, and any new project takes 7 to 10 years to bring online. Translation: no meaningful new supply is coming. Every year, the gap widens between consumption and production, draining global inventories. That is why COMEX is tightening, why LBMA shipments are delaying, and why India is in backwardation. The physical metal is vanishing. Now here's the critical insight. December 27th, January 26th, March 26th. These dates are not random. They are pressure points, moments where the deficit, vault depletion, and physical scarcity collide directly with delivery obligations. December aligns with year-end book closures and India's explosive seasonal demand. January brings post-reset flows and continuing Indian consumption. March is the final major delivery month. No more rolling contracts, no escape routes. Each date is a potential ignition point where one oversized delivery request, one industrial panic, or one COMEX vault failure could break the system, and the probability intensifies as each date approaches. If December carries a 20% chance, January climbs to perhaps 40%, and March rises toward an unavoidable 80% probability. By March, the math is merciless. Vaults drained, open interest enormous, shorts trapped. Something snaps. So what happens to price if one of these dates triggers the break? Short-term target, $70 silver. If December or January produce even a mini squeeze, silver could gap from $33 to $50 overnight, grind to $60 within 2 weeks, and then spike towards $70 as short sellers scramble for cover. This aligns with the bull flag measured move plus the breakout above the 2011 highs. $70 becomes the first major resistance zone where institutional algorithms fire, options clusters hit, and profit-taking begins. But $70 is not the final destination. Intermediate targets, $200 to $300. If March triggers the full systemic break, forced cash settlements, physical disconnecting from paper, the real-world premiums drive price violently higher. If COMEX sits at $70 and physical premiums rise to $50, $120 silver. If premiums widen to $100, $170 silver. If premiums reach $150, $220 silver. This range reflects a severe shortage, though not yet absolute systemic failure. Long-term target, $600 to $670. This target comes from two powerful structures: the cup and handle breakout originating from the 1980 peak, the 2.618 Fibonacci extension stretching from the 2001 low to the 2011 high, projected into the 2025 breakout window. Now, what do you actually do with these 3 dates? 1. Mark the dates. December 27th, January 26th, March 26th. These are the windows, The stress points. Monitor critical data around these days. COMEX registered inventory open interest levels, physical premiums, backwardation signals. If registered inventory sinks below 140 million ounces before December, risk skyrockets. If March open interest exceeds 100,000 contracts, pressure becomes extreme. If Indian physical premiums exceed $5, the shortage becomes acute. 2. Position before December. If you believe one of these windows triggers the break, you need physical silver now. Not at $50, not when premiums hit $20, but now at $33 with $3 premiums. Because once the break occurs, the market locks up. Dealers sell out, mints move to 6 to 8 week delays, premiums double, retail buyers get priced out entirely, availability becomes the constraint. Third, understand the timeline. December is the first spark. If nothing erupts, January carries the pressure forward. If January doesn't snap, March becomes the end game. 3 windows, 3 stress points. One of them is statistically likely to rupture the system. 4. Do not wait for confirmation. When silver gaps from $33 to $50 overnight, when premiums suddenly jump to $15, when COMEX delivery failures hit the wire, it's already too late. Once mainstream media reports it, physical metal becomes unobtainable. You must see it before it becomes obvious. That foresight is your edge. The brutal truth. These 3 dates matter because the silver market is fundamentally broken and has been for decades. Paper contracts trade at 100 to 1 leverage over physical. COMEX has issued 500 million ounces of paper silver, backed by barely 15 million ounces of deliverable metal. This is legalized fraud until someone demands delivery. When the shortage becomes undeniable, when one of these dates forces COMEX to admit it cannot deliver, the illusion collapses. Cash settlements will be imposed. Paper will decouple from physical. Price discovery will migrate from New York to Shanghai, Mumbai, and private bullion deals. And the holders of paper contracts will learn the painful lesson. Paper is not metal. Promises are not silver. COMEX is not a commodity exchange. It's a casino designed to protect the house. If this opened your eyes to the 3 critical dates that could fracture the silver market, subscribe. Because I am tracking every metric from now through March. Registered inventory updates, open interest trends, Indian premiums, LBMA delays, MCX backwardation. When the pressure finally releases, you'll want real-time clarity. Next video, why India's MCX backwardation is the most important silver signal in the world, and how it's forecasting the COMEX rupture before the West even sees it. 3 dates, December 27th, January 26th, March 26th. One of them detonates the system. The setup is perfect. The pressure is rising. The window to position is closing. Do not wait for the break. There's a widening gulf in America, a silent, expanding chasm between what the official data insists is happening and what you feel every single day in your wallet. And that gap, that crushing cost of living trap, is about to define the next decade of economic reality in the United States. Because while inflation may appear to be cooling on paper, while the CPI claims a harmless 3%, the damage is already locked in. Prices are not retreating, wages are not catching up, and the system is engineered to assure you everything is fine while you silently drown. In the next 15 minutes, I'm going to show you why official inflation is not merely misleading. It is a mathematical fabrication built directly into the way CPI is constructed. I'm going to show you why the 1970s inflation pattern, the period where inflation stabilized at 3% before erupting into 14%, is the exact blueprint we are following right now. I will break down the 3 pillars of CPI, goods, shelter, and energy, and expose how each one is structured to understate the real-world price increases destroying household budgets. And I'll explain why a lower official inflation rate is not relief at all. It is the exact opposite. It means the cost of living gap widens. It means your purchasing power erodes faster. It means you get poorer while the government declares victory. This is not theory. This is not opinion. This is verifiable data, and once you understand it, you cannot unsee it. Let's begin with the number everyone blindly trusts, the Consumer Price Index, CPI, the government's official inflation thermometer. As of December 2025, CPI claims inflation has cooled to 3%, down from the 9% spike of 2022. The Federal Reserve celebrates. Media pundits declare triumph. Mission accomplished, they say. But here's what no one tells you. CPI is not a measure of prices. It is a measure of the rate of change of a constantly shifting, government-weighted basket of goods. A basket that is adjusted, manipulated, and rebalanced every year. Let's break down the 3 built-in distortions. 1. Substitution bias, the quiet lifestyle. Downgrade CPI does not measure the cost of maintaining the same lifestyle. It measures the cost of maintaining a cheaper lifestyle. When steak becomes too expensive, CPI simply replaces it with chicken. When chicken becomes too expensive, it replaces it with beans. The assumption is that you will automatically downgrade. So CPI never captures what it costs to live the same life, only what it costs to live a shrinking one while pretending it's equivalent. 2. Hedonic adjustments. Inflation hidden behind quality. If a new car costs 20% more but comes with a backup camera, CPI reduces the measured price increase. The logic, the car improved, so the real price didn't rise as much. But here's the truth. You can't eat a backup camera. You can't pay your rent with improved software. These adjustments hide real inflation. 3. Weighting. The CPI that doesn't match your life shelter is weighted at 36%. Food is weighted at 13%. Energy is weighted at 7%. But your life does not match this average. Nearly no one's does. If you rent in a large city, shelter might be 50% of your budget. If you commute long distances, energy might be 15% of your budget. CPI does not reflect real households. It reflects a fictional average American who does not exist. So when the government announces inflation is 3%, what they really mean is the cost of a substituted, quality-adjusted, artificially weighted basket rose 3% for a hypothetical consumer, not for you. A statistical construct, not a human reality. Now let's confront the truth. What actually happened to prices? The real-world numbers households face every day. And from here, we must look at the most important historical template, the 1970s inflation cycle, because the similarities are not subtle. 1972, inflation was 3%. The Fed declared victory. Nixon celebrated stability. Then came 1973. The oil embargo hit. Inflation doubled to 6%. By 1974, it was 11%. The Fed panicked, raised rates, inflation dipped temporarily, then exploded again in 1979 to 11% and 14% by 1980. Interest rates hit 20%, housing collapsed, unemployment surged, a generation lost its savings. The pattern was painfully clear. Inflation looked stable until it detonated. Why? Because the underlying forces, money printing, deficit spending, energy shocks, were never addressed. They were merely suppressed. Now look at our era. 2019, 1.8%. Stable, calm. 2020, pandemic money printing ignites, $6 trillion in stimulus. 2021, inflation jumps to 4.7%. Transitory, they said. 2022, inflation hits 9%. Panic. 2023 to 2025. Inflation declines to 3%. The Fed celebrates again, but the pattern is identical, stable at 3%. Underlying stress building, and all it takes is one shock, tariffs, geopolitical conflict, a debt crisis, to ignite a second wave to 10% or higher, mirroring 1979. Now let's dissect the 3 CPI components to show why the headline number is about to become meaningless. Component 1, goods, the distraction. Goods are cars, electronics, appliances, clothing, roughly 20% of CPI. Goods inflation has been low because globalization made imports cheap for 30 years. Electronics and clothing have been deflationary. Tariffs added only mild upward pressure. A TV that cost $1,000 in 2000 costs $400 today. But you're not buying TVs every month. You buy gasoline. You pay rent. You buy groceries. Goods inflation is not the driver of your pain, it's the distraction. Component 2, shelter. The manipulated giant shelter is the largest component of CPI, 36%, and the most distorted. CPI does not track home prices. It tracks owner's equivalent rent, a theoretical value based on surveys asking homeowners what they think their house would rent for. Home prices soared 40% from 2020 to 2022. Rents lagged due to annual leases. When rents finally spiked, shelter inflation hit 8% and pulled CPI upward. Now, in 2025, home prices softened, mortgage rates at 7% froze buyers. Rents flattened, CPI shelter. Inflation is falling from 8% to 5% toward 3%. But here's the trap. Shelter costs didn't fall. They just stopped rising as fast. CPI interprets slower pain as victory. Component 3, energy, the hidden detonator. Energy is only 7% of CPI, but it is the lever that moves the entire economy. Energy affects food prices, transportation, goods utilities, rent. Manufacturing oil dropped from $120 per barrel in 2022 to $70 by late 2025, a 42% drop, pulling official inflation down. They affect rent through your utility bills. Energy is the master leverage point of the entire system. And right now, yes, energy inflation is falling. Why? Because oil prices have dropped. WTI crude was around $120 a barrel in mid-2022. By late 2025, it's hovering near $70, roughly a 42% decline. Gasoline fell from about $5 a gallon to around $3.40. Natural gas prices crashed as production surged and winters turned milder. On paper, this is fantastic for CPI. Energy deflation drags the official inflation number down, neatly offsetting rising costs elsewhere. The Federal Reserve loves this because it makes their job look easy. Inflation is falling, they say, and we didn't even have to obliterate the entire economy. But here's the dark side of that story. Energy prices are falling because demand is weak. Global growth is slowing. China's economy is stagnating. Europe is sliding into recession. US manufacturing is contracting. Weak demand means lower energy consumption, which means lower prices. But weak demand also means a weak economy. So yes, CPI is falling, but the underlying economy is deteriorating. You're not paying less for gas because you're winning. You're paying less for gas because you're unemployed, underpaid, or cutting back. That's not victory. That's collapse with a smile. Now let's talk about the cost of living gap, the most important concept in this entire video. Even if CPI prints 3%, even if inflation is low in the official narrative, the cost of living has already exploded because prices don't reset back down after a spike. They ratchet higher and stay there. Take a simple example. In 2019, a median household making around $68,000 could afford a home in the low to mid $300,000 range with a 4% mortgage. That world is gone. Home prices jumped, mortgage rates doubled, and even though CPI today says 3% inflation, you are now trying to survive in a world where the baseline price level is 20 to 40% higher than it was just a few years ago. Now let's look at what happens next. The government will celebrate the victory over inflation. The Federal Reserve will cut rates. They're already signaling rate cuts in 2025. Markets will cheer, stocks will climb, bonds will rally, real estate will stabilize or rise, asset owners will get richer, but the real economy, the people living paycheck to paycheck, won't feel relief because prices aren't falling, they're just rising slower, and slower inflation does not. Pay your rent, fill your gas tank, put enough food in your cart. The cost of living gap not only persists, it widens. While CPI drifts downward, wages stay flat. Unemployment nudges higher. Layoffs accelerate, the economy slows, and the people at the bottom, the ones without stocks, without real estate, without assets to leverage, fall further behind. Here's the brutal mechanism nobody at the top wants to explain. Lower CPI. Lower interest rates, cheaper borrowing for those who already have collateral. Corporations borrow nearly free money. The wealthy leverage assets. Investors scoop up stocks, real estate, and bonds. Asset prices inflate. The wealthy get wealthier.